Abhijit. In 1971, his grandfather constructed a house on a plot purchased by him. In 2015, his father demolished it and constructed a new house from his own funds, and in 2016, Abhijit's grandfather gifted him the same house. Now Abhijit is in a dilemma. He is planning to sell the house. He had heard of indexation but had no idea how to calculate the indexation. Also, he is confused and curious about the tax laws that are applicable on his inherited property. Let's understand the tax implications of inheriting assets and selling them, keeping in consideration Abhijit's case. India does not have any inheritance tax, which means the person inheriting any asset either through a will or under the personal law does not have to pay any tax on it. Moreover, Section 56 Clause 2 specifically provides for exemption on assets received at the time of inheritance. However, the person receiving the inheritance has to pay tax on the income earned in respect of the assets inherited by him once he becomes the owner of the same. So like Abhijit, if you too are planning to sell your inherited property, you will have to pay capital gains tax on the profit earned after considering the inflation and indexation benefit. Indexation is a process by which the cost of acquisition is adjusted for the inflationary rise in the value of assets based on the cost inflation index notified by the central government. Most of the long-term capital gains are derived after availing the benefit of indexation. Such indexation benefit is available on the basis of Cost Inflation Index, which is CII, of the financial year in which the capital asset was purchased and the year in which it was sold. For instance, the CII for financial year 2020-21 was 301 and for financial year 2021-22 it was 317. Since the plot was held for more than 2 years in Abhijit's case, he is eligible for the benefit of indexation, and the index cost of plot would be calculated by applying the formula where index cost of acquisition is equal to cost of acquisition multiplied by the cost inflation index of the year in which asset is sold divided by CII for the year in which plot was first held by the previous owner or financial year 2001-2002, whichever is later. That is, in Abhijit's case, it is financial year 2001-2002. Capital gains can be classified as either long-term capital gains or short-term capital gains. So if you sell a house within 24 months, you have to pay an STCG tax on the gains as per your income tax slab. After 24 months, you have to pay an LTCG tax, which is charged at 20% with indexation benefits. If you sell a property that was gifted to you or that you have inherited, you are still liable to pay capital gains tax. The cost of purchase is calculated on the basis of the cost to the previous owner indexed to the year of purchase. CA and tax expert Raj Chawla says to reduce tax liability, Section 54 gives you an exemption if you sell a property and buy another one. It is available when the capital gains from property sale are reinvested into buying or constructing maximum 2 houses. However, the capital gains on the sale of house properties in order to claim exemption for reinvesting in 2 properties. This benefit can be claimed only once in a lifetime.